And what we're going to do next is we're going to take what used to be called a HUD statement. It's now called the ALTA Settlement Statement, which contains all the information about the purchase or of the sale of a property. Usually the way the ALTA statement or the HUD statement is designed is you're going to see debits on one side, credits on the other side. And it's really different depending on what side of the transaction you're in. If you're a seller of the transaction, some items pertain to you. If you're the buyer, other items pertain to you. So we're going to be focusing for this video on the buyer side. So let's say I am the one that's buying the property. I'm the purchaser of the property. So I'm only going to be looking at the numbers that are on the right-hand side under buyer/borrower. Now, depending on how you buy the property or what you're going to do with it, the way you enter this information in QuickBooks could vary. For example, if I am purchasing this property and then I'm going to rent it or lease it out through the year, certain items are going to be operating expenses such as property taxes, homeowners association, homeowners insurance. So we have to enter them as such. But if I'm buying this property and I'm going to maybe add some additional improvements and then flip it or sell it in the near future where I'm not going to rent it, then the items in here are going to be entered differently. So we're going to do that example afterwards. So first we're going to start with the example of I am the buyer and I'm buying this property so I can rent it out. Then we're going to do the buyer buy this property so I can flip it. Then we're going to do the seller. Right, so I'm selling a property I already owned. If that was a rental property, and then the last one would be the counterpart to the flipping scenario, which I'm the seller and I'm selling a property that I have just finished flipping, or I'm just flipping at the moment. So let's start with talking about the purchase of the property for rental purposes. So let's look at the ALTA statement first and let's point out a couple of things. First, we have the sales price, which in this case would be the purchase price, which is $525. Now that is the contract purchase price. That's what you negotiated as the buyer as what you're going to pay for the property. Now during the closing timeline, there could be some changes to that price, maybe some seller adjustments or buyer credits or something like that. We're going to see that as we come along. So let's break down these numbers. First, we have the sales price $525, and that's going to be a debit. That's an increase of my asset, right? Then I'm going to have $10,000, which is a deposit. That's money that I paid upon contract before the closing of the property. So that's money that should have come out of my bank account before. Then we have the loan amount. This is how much our bank is lending us. So that's going to be a liability. It's going to be the mortgage that's going to be recorded in our balance sheet. Then we have some adjustments and prorations to property taxes or city and county taxes. So we see a couple of numbers here. Generally, we're going to throw those into the property tax expense. And then when we actually end up paying the property tax at the end of the year, that's all going to net out to the proportion that pertains to me for the year that I have consumed it based on the date that you purchased it. Then we're going to see maybe homeowners association credits. Again, this is for the portion of the homeowners association that me as a buyer need to pay to make whole of the month of a quarter or whatever it happens to be. Then we're going to see some prepaid interest. That's going to be us paying part of the interest of the mortgage until our next payment comes due. And then usually you're going to see a whole bunch of loan charges. Typically, and depending on the type of accountant, typically you're either going to put all the loan charges into its own account that you're going to amortize over time. In my opinion, to simplify it, we're going to throw all those loan charges as the acquisition cost of the property. So we're going to put that all as part of the asset value. Okay, including flood certifications, surveys, title fees, all that stuff is going to be part of the acquisition of the property. Now, you're also going to see, in some cases, you're going to see impounds. And basically, these are prepayments towards something that you have to pay in the future. So, for example, these impounds here, like homeowners insurance and property insurance, that's designed for me to have basically a reserve or a deposit into those payments. So that's going to be part of an asset, sort of a current asset. Then we're going to see things like title charges. That's all going to be, again, in my opinion, part of the value, the acquisition cost of the property. Let's go to the second page here. And on the second page, we see a couple of things here. We see some additional sort of deed, mortgage, document stamps. Again, That'll be part of the purchase or acquisition price of the property. We're going to see us paying some homeowners insurance. So that's going to be an expense, an operating expense. And then this broker fee, I usually just make that part of the acquisition of the property. And at the end, we're going to see a really, really important number, which is the one that says due from borrower. That's the total amount that the buyer shows up at the closing table with, either a check or a wire transfer to the title company upon closing, which is that $59,000. So let's take a look at what a journal entry would look like. So I'm going to move the ALTA statement to the left-hand side and have QuickBooks on the right-hand side, so we can follow along here. So let's start with the deposit. So the first $10,000 that were paid, that probably happened 30 days, 60 days, whatever that closing period is, before this actual closing happened. So let me go ahead and create a check. And let's say that's the money that we paid up front when we put an offer on the table for this property. So I'm going to put here title company. Let's say we put the money straight into the title company. In some cases, the deposit goes to the real estate office of the realtor who's representing the seller. But to simplify, I'll just put title company here. And then we'll put here the category. We're going to put the property name. So let's call this one 123 house. Okay, so we're gonna create a fixed asset called 123 house. And let's say that's the name of the property that we're buying. And this is going to be a fixed asset because we're going to rent out the property and we're going to depreciate it. So we have to make sure that we put that on the 123 house. The detail type is never important. Just to simplify it, I'm going to put here buildings, and then we'll put here 123 house, and then click on save and close. So that created my fixed asset. That's going to be the first step. So the amount here is going to be $10,000. And that happened, like I said, probably a month before we closed on the property. So let's assume that we bought this property in 2018. Let's just use 2018 dates. And then when we do the sale transaction, we do it for 2019, so we can see what happens during the year in terms of adding some improvements and having some depreciation. All that stuff, we'll cover that later on. So for now, we went ahead and made a deposit for May 1st, 2018 for $10,000, and that's in the books, and that's going against my bank account. Perfect. So I'll hit save and close. So if I go to my balance sheet, let me open up my reports and go to my balance sheet, I should now have a fixed asset for $10,000, and that's what I want, right? That was the deposit. Then the next transaction is going to be the actual closing of the property. So for that, we can do a journal entry. I think journal entries are a little bit easier to follow in this case, so we'll do a journal entry. So I'm going to open up a journal entry here. And let's say this happened on June 17th, 2018. Okay, so we have a couple of accounts to deal with. The first one is, the easy one is going to be the property. So for the time being, I'm just going to put the purchase price of the property in here. So I'm going to put $525. Okay, now because I've already put a down payment, the $10,000, I'm going to reduce that $10,000. I'm going to do it just to make it easier to visualize. I'm going to use the same exact asset account and do a credit. However, you could have just reduced it from the debit and make that $515, but just to kind of follow along the HUD statement, the ALTA statement, it'll make it much easier if I do it this way. So this is the same asset account that's being increased and reduced. Perfect. Okay, under description, we can put here sales price or purchase price, probably contract price, probably the best one. And then here we can put down payment. Okay, that will simplify things. Then on this, the third line here is loan amount. So that's you're usually going to put the bank's name. So let's put here Wells Fargo Mortgage. Okay, so our Wells Fargo Mortgage is going to be a long-term liability because that's usually more than a year. And then under detail type, we can put other long-term liability. Let me copy the name because sometimes that changes when I change that. And then I'll click on save and close. Perfect. So that the credit's going to be $472,500, and we'll put here principal balance. Okay, perfect. So the next one's going to be all these adjustments. The first two are adjustments to property tax. So in this case, if you see here, there is some adjustments from the purchase date through, I guess, the renewal date for the county. And then we have some that are for the beginning of the year until the date that we closed it. So just to simplify things, I'm going to put all that stuff under property taxes, but both lines in there. So I'll put the adjustments to property taxes in here. So 382.23, and then the second one will be the same thing, 32701.78. Okay, perfect. So this would be prorations, adjustments to property taxes. Perfect. Okay, so the next one's going to be the homeowners association. So we'll have, let's create an HOA fees expense account, and that's going to be 61.54. So that's us paying the HOA fees for the rest of the quarter that the seller had already paid for up front. Then we have prepaid interest, so that's just going to go into my interest paid expense account. So 757.96. Put here prepaid interest, and we'll also put here prepaid HOA. Okay, perfect. So these are things that I'm sort of paying at the closing up front. Then we have all of these loan origination charges and fees. I'm going to make that all part of the property. So I'm going to put the property name here, and I'll add up all these numbers. Okay, and then I'm going to call this one origination fees. I will call it origination and title doc fees. Again, I'll make a quick disclaimer. Some accountants like to take the financing portion, the points, and the origination fee, and separate that and create a different account altogether, an asset account, and amortize that over time. For tax purposes, you may need to do that. That's possible. So if that was the case, you would separate whatever is a points or origination fee, which is basically the bank charging interest up front, and you would separate the two, and then you would amortize that over the life of the loan. To simplify it, I'm just going to take the interest expense from the mortgage as my actual mortgage expense, and I'm throwing all this as part of the value of the property. But it's important to disclaim that some accountants will separate those two things. Okay, let's come down. Let's go over in pounds. So this is us basically getting our homeowners insurance and our property taxes, and that aggregate adjustment, it's probably an adjustment to property taxes, basically being paid up front. So what I'm going to do in this case is I'm going to make a prepaid expense asset account where all those things are going to be in there. So I'm going to call it prepaid in pounds, and this would be the equivalent of the money that goes into the escrow that then gets adjusted every year for you to pay your property taxes and all that stuff. So this would be like sort of an escrow. Let's call it here escrow. That might be easier to see that way. So prepaid in pounds, and then I'm going to split off the two. So I'm going to call it prepaid homeowners insurance, and that's going to be 740.01, and then I'll use the same account here, 6268.50. This will be prepaid property taxes. And again, these two also get amortized over the life of the year or the couple of months that are being prepaid. So you're supposed to charge those assets against cost at some point. Okay, perfect. So then we have all these title charges. So this one's going to be adjusted also. Sorry, I'm going to adjust that accumulated adjustments as well, which I think has to do with property taxes. That's that 1,200. I have no idea what that is, but it's under property taxes, so I'll throw it in there. Okay, so then we have title charges. That's all going to be part of the purchase of the property. So we put 123 house, and let's add that up. 925 plus 2,700 plus 850. And let's call that one title charges. Okay, perfect. Title charges. Then the next one here says government recording and transfer charges. That's going to be the same thing. We'll go ahead and add those up in there. So that's 27 plus 170, 150 plus 1653.75 plus 945. Perfect. So that will be called government recording fees. I'm trying to use the same headers that you see on the ALTA statement, so you can use this journal entry as a model. Okay, so the next one is going to be other charges. These are going to be operating expenses. So in this case, I'm actually paying some homeowners insurance, and this 345, that broker fee, that will be part of the acquisition. So let's do the homeowners insurance. So let's do insurance, and that's going to be 2960, and then we'll call this one homeowners insurance. Homeowners insurance. And then the last one would be the broker's fee, which in this case is the same property here. So that's 345. Okay, so let's see where we are here. So let's figure everything out. So we got the 525 check, we have the 10,000, we have the mortgage amount, we have the adjustments to the property taxes. Oh, we missed a line here. We missed the seller's credit. So let's enter that seller's credit. That was my fault. So that would be 123 house. That's part of the value of the property. Let's call this one seller's credit. And that's going to be a credit of 1575. And then we're going to grab that and put it right under it. That was just something I missed in the process. So there's that seller's credit. That's the seller lowering the price of the house. Maybe something went wrong during the inspection or something like that. Okay. All right, perfect. So then at the end, the last transaction is going to be let me go all the way down here, will be the 59,243 coming out of the bank account. So I'm just going to select the bank account here, and that last dollar amount should be 59,243.13. Okay, let me see what's left here. So we have a balance here, so I could have missed something in the process. So let's see what else we have missing in here. So let's go down the line. So okay, so we got the seller's credit. We have the two property tax adjustments here, and they're on the right side. We have the HOA. We have the interest paid. Let me change the order of that. And then we have 6665, which is the other origination fees, which is all these numbers put together. Let me add them up one more time just in case. Okay, that's a significantly different number. All right, let's see what the next one is. So we have prepaid in pounds. That's a 740.01. Then we have 62. Let's do this one again. 68.50 minus 1233.35. That's this one here. Okay, so that one's accurate. Then we have the title charges, and that looks about right. And then we have the government fees, and that also looks about right. Then we have the insurance and the broker's fee. All right, let me go ahead and delete this line. Okay, perfect. So that worked perfectly. So my error was on this calculation somehow. So now that we have completely balanced, every single number of this journal entry ties to that ALTA statement. I'm going to hit on save. And then what I'll do is I'll save this transaction journal. And I'm going to post this journal as a PDF into the portal. So when you log into the portal of the advanced webinar members only section, you'll be able to download that journal so you can use it as an example and compare it against the ALTA statement. Both the ALTA statement and the journal is going to be available for download in there. Okay, perfect. So that did it. So let's go into reports. Let's go into balance sheet. And now we see our house. So our house here is 534,508. That's the original purchase price plus all those additional closing costs, all added to the value of the property. So because we're going to rent the property, you probably want to separate the land away from the house, especially when you're dealing with a home that has a significant value of the land. The land itself is technically not tax deductible in terms of depreciation. So we're going to have to separate the value of the house from the value of the land. Now, getting the value of the land it could be kind of tricky. Some people go into the local county property appraiser and see what the government has appraised the property for. In the US, typically, most counties appraise the property so they can charge their property taxes. So you can look at that proportion and do it that way, or you can do a straight percentage like 20%. There's no right or wrong way to do it. Every accountant probably has their own way. So I'm going to go ahead and do it 20% of the acquisition price. So I'm just going to take that number. Okay, I'm going to do a journal entry. Okay, and I'm going to take that number and multiply it times 0.2. Okay, do that again. There's the number and multiply that times 0.2. That should give me 20%. Okay, that's perfect. So let's call this one 123 house land. So we'll make that land and we'll separate that as a fixed asset as well. So that's the land portion. And down here somewhere, there should be an option for land. And I'll click save and close. And then the adjustment goes against the property value itself. So against the one that's not the land. So I'm going to credit it to reduce the value and debit the land to increase the value of the land. And I'll use the same purchase price as the date. So when I separate the two, I should see now the portion that's the property and the portion that's land. I should probably go into the chart of accounts and be consistent and put building next to it or something like that. So that would be a good idea. So we'll put building next to it. It should be much easier. Perfect. And then at some point in the future, once you depreciate the property, you're going to see accumulated depreciation. Let me run the balance sheet here. You will see accumulated depreciation against that, and there will be another fixed asset account called accumulated depreciation, which will be negative, and it'll reduce the value of that building. So we have everything we need. We have the impound or the escrow to our prepaid expenses, HOA and property taxes. We have our building and our land, and we have the mortgage.